Okay, now that's not a typo. That is $79 versus $34,000. That is a very large amount of money to lose to fees. The stocks is very simple to calculate the fees. Most trading account places, either banks or other institutions that allow you to buy and sell stocks, the trading fee is typically $9.99. So when you buy shares, pay a flat rate of $9.99. When you sell, there's a flat rate of $9.99. So what I did here is I took an example of buying 4 stocks, right? So that would come out to like $40. And at the end of 25 years, you sell the 4 stocks, and that comes out, it's another $40. So it's $79 total lost to fees versus $34,100 lost to fees. Most people have mutual funds where the MER is greater than 1.5%, so you're losing even more than that. So over your lifetime, you are spending a lot of money in fees. Reason number 2, early redemption by mutual fund owners. So what happens in this example is when let's say the stock market is crashing or there's a recession, stock prices are going down. When stock prices go down, mutual funds go down because they are essentially buying stocks. What happens is people get nervous, they get scared, they call their mutual fund company and they want their money back. At that point, the fund manager has no choice but to sell the stocks so that he can give the cash back to the investors. This is detrimental to you. Let's say if you're in it for the long term, you know that the markets go up and down, you know that stock prices go up and down, and you know that over the long term you'll do fine. You know, the stock market has done very well over the long term, and you decide to keep your money in the mutual funds, but everyone else is calling their fund manager asking for their money back. This is detrimental to you because as a whole, the entire mutual fund, the portfolio drops in value because the fund manager has no choice but to sell the stocks. Even if you've got a fund manager who's very smart, they know what they're doing, they know that these stocks are undervalued, they should not be selling them right now. They know that if you just hang on to them for another 18 months, maybe another 22 months or something like that, the stock prices are going to go back up again. But the fund manager has no choice. Their hands are tied. When people are calling and they want their money back, the fund manager has to sell stocks even at a loss. And that is detrimental to the performance of your mutual funds. Reason number 3, short-term focus instead of long-term gain. Most mutual fund companies, they operate the same way. They have a 12-month focus. Fund manager performance reviews are all done once a year. Bonuses are done annually. And that's really their focus. As a fund manager, if you can sell a stock today and lock in 8% return, which is not bad, and you know that this is going to help your performance review, it's going to help you get that bonus, you're probably more likely to sell the stock. Even though you may know that if you hang on to it for another 16, 18 months, 22 months, you may end up with, 12% return. But why take that risk? Why hold on to that stock for another 2 years for a 12, 15% return when you can guarantee you can sell it today and make 8%? Right? You may not even, as a fund manager, you may not even be working at the same place 2 years from now. So there is a short-term sort of focus. They're interested in selling quickly. In Canada, the RSP season starts in February, beginning of the year. And again, mutual fund companies want to lock in the returns, show the returns on their brochures, on the internet, on advertising in the paper. Say, hey, we did 9% last year, or our fund did 8.2% last year. And they can put all that into their promotional and marketing material to try and get more investors for the next RSP season. Whereas if you're investing on your own, you have a long-term focus. You know you've bought a stock that it's undervalued. You know that if you hang on to it, the dividends increase year after year after year. Pretty soon you could be earning double-digit returns just from dividends alone. You can control when you're going to sell the stocks. You don't have anybody forcing you like a fund manager would be forced to sell stocks. Let's take a look at this example for the next reason number 4. Imagine this is your mutual fund portfolio. The first year you made 4.2%, then you made 5.1%. Things look like they're going pretty good. You're making good money. And then in 2009 there's a negative 28.3%. So what happened? The mutual fund was doing so well. The returns were coming in. Everything was great. What happened in 2009 for it to drop like that? Now these are sort of fictional numbers that we've got on the chart here, but this represents true cases where this has happened to mutual fund investors. And what's happened is a good fund manager has been lured away to another mutual fund company. There's very, very few good mutual fund managers out there in the world. You could probably count them on one hand. And the ones that are very good are in high demand. And they're constantly being offered a job at another institution, at another bank, or another mutual fund company, and they're moving around. So you as a mutual fund investor have no way of knowing that your fund manager just left the job and is now working someplace else. Okay, mutual fund companies don't want to advertise that fact that they've just lost their star manager. So the only hint you're going to get is at the end of the year when you get your statement and you realize, whoa, what happened here? Why did I lose so much money all of a sudden? You know, things were going so well for the last 6, 7, 8, 9 years, and now what happened? And what some people try and do is they will actually, if they find out, you know, the fund manager has changed, they've gone to a different place, they try and sell their mutual funds and then move the money into another institution. Now this is exactly the wrong time to sell, is when prices are down. So you want to be careful. I just want to bring up a point here. It just reminded me, the stock market is the only place in the world where people actually buy more when stock prices are going up and sell when stock prices are going down. Anything else in life, whether it's food, clothing, electronics, or anything, you know, you wait for things to go on sale. And when they do, that's when you buy more and you stock up on it. And then when prices go up, you say, well, you know, I'm going to wait. I'm going to wait for it to go on sale and then buy it. But in the stock market, people get greedy. When stock prices are going up, people get greedy. They think they're going to make a quick buck and they start buying stocks. And when prices are going down, people panic and they don't want to lose their money and they start selling their stocks. And that's exactly the wrong time to sell, is when prices are down. So in this example, if you were to sell when everything was down, the only thing you've done is you've solidified your losses. And then when you move your money over to the next mutual fund company where the star manager is now working at, and if he or she has done a good job, the performance of their funds has crept up, and now you're buying them when they're high again, and that's the wrong time to buy. And the last reason here, reason number 5, historically the majority of mutual funds have underperformed the stock market. So there's tons and tons of books written on this topic here. Different books have different sort of numbers, but what I've found is since the beginning of, the last 85, 90 years stock market history, the stock market has returned an average annual compounded rate of return of around 10%. So over the long term, you should be making approximately about 10%. And if you're not, then you're losing money, because you could have easily put that money into an index fund. An index fund is a mutual fund. Works a little differently. There's no fund manager who's buying and selling stocks. It's just a computer program who buys a whole bunch of stocks. For example, the S&P 500 index fund would have the top 500 companies in the US, and it would invest in that. And the only time it would sell is if, you know, a company in that list was removed and replaced by another company. Then the computer for the index fund would sell those shares and buy the new ones. So index mutual funds do a very good job of tracking the stock market performance. Again, so getting back to this reason number 5, a number of books written on the topic, and some mention as high as 85 to 90% of mutual funds in the world underperform the stock market. So that is huge. In summary, you want to buy quality companies when they are undervalued. And dividends are very, very important, especially increasing dividends, because that is going to increase the amount of money you receive year after year after year after year. And investing is not risky if you know what you're doing. Okay, we minimize that risk by investing in recession-proof companies, companies with solid products or services that are going to be around for 20 years or more. And we invest in companies that have a history of increasing dividends year after year after year.